The fourth and final area we're going to look at is market ratios, and these all have some financial statement amount compared with the market price of the company's stock. Some people say that's very objective, some say subjective. Objective from the standpoint that the market price is determined by people outside the company, so it's not in the company's control, so it's more real. Subjective from the fact that the market price can't be controlled by the company, so it makes it harder for them to improve or take actions to make this better, although they can indirectly. So first one we're going to look at is earnings per share, and this is a huge one that a lot of people utilize. So stockholders and management look at this number. It's net income after federal tax divided by the number of outstanding shares of stock. So don't forget, outstanding shares do not include treasury stock in them. Those are not outstanding. So it's looking at how much the company earns as a share. So stockholders and management frequently look at this as a measure of success of the company. If earnings per share goes up, that typically means that people want to buy the stock, and if people want to buy the stock price tends to go up, and if that stock price tends to go up, then it's easier for the company to issue more shares of stock or to go out and borrow money as well, so it helps in all regards. These last three bullet points are important, and we'll come back to them some. So a simple capital structure means that there's no convertible bonds or convertible preferred stock or stock options to key employees that are outstanding. And that is what the book company is a simple capital structure. However, if they do have these convertible securities or stock options, then it's considered a complex capital structure. And if it's a complex capital structure, you have more calculations that you have to make related to diluted shares and diluted earnings per share. So we will come back to these three in a bit. So let's look at the actual calculation for earnings per share. So you take net income, which comes from the income statement, minus preferred dividends, divided by shares of common stock outstanding. And these come from the statement of stockholders' equity. And again, as a reminder, shares of common stock outstanding do not include treasury stock, NOT not. So if you look at this calculation for our particular company and what it means, you will notice that from X1 to X2, net income went up, so you would think earnings per share would go up, but it didn't. It went down, and that was driven by the preferred dividends going up. So there were more preferred shares that people were getting dividends on. So that meant EPS went down. Not good from year to year, despite income going up. If you look at the relationship of the last 2 years, net income went down. Not good. This stayed the same. So EPS went down because net income went down. So things are not good for this company as you look year to year. They need to improve this earnings per share number by driving up net income if they can, because every shareholder wants that. So let's look at the diluted comment from here. So if you would, look at your textbook on page 387 on the right-hand column, that last full paragraph. It says, for example, assuming that during 2000X3, Forrest issues bonds that can be converted to 5,000 shares of common stock, which we did in a previous chapter. Even though the bonds weren't converted during 2000X3, the company would have to calculate and disclose diluted earnings per share in addition to regular or basic that we just computed. The only part of the calculation that would change would be the number of shares of common stock outstanding. For calculating diluted earnings per share, it assumes that all 5,000 shares of common stock have been issued. So their new calculation on earnings per share, it'd still be 92,882.71 minus 76.50, but it'd be divided by 70,000 shares, the 65 that are outstanding plus the assumed conversion of 5,000 more shares that would be outstanding of 70,000. And if you did that, you would get $1.22. And it says there in the book, notice this calculation indicates that each share only earns $1.22. Diluted earnings per share gives the stockholder a worst case scenario of earnings. This lower earnings would only come true if everyone holding those convertible bonds did in fact convert them to shares. So if I have any convertible securities or stock options, I have to assume that they get converted and issued and change the shares outstanding, which means that diluted is always going to be less than basic. The next measure is price earnings ratio. So this is our second one. This one we usually want to use in conjunction with other financial measures, and you'll see why once we look into it. But that first bullet point there says it's the price at which a share of stock may be sold on a stock market at any given time is called the market value. So hopefully we already know that. So we can get that number from Wall Street Journal, Yahoo Finance, whatever, what it's trading at on the market. So price earnings ratio is that relationship between the market value per share and the earnings per share we just calculated. Hence price earnings ratio, PE ratio. And this is the amount, or not the amount, this is actually something that we ought to compare similar companies in our same industry. So it varies substantially from industry to industry. So we want to look more closely at competitors or other companies in our industry when we're determining if it's good or bad. Higher is usually considered better than lower, but not necessarily true all the time. And I want to, again, read with you in the book about that on page 388, right-hand side again, first paragraph, a little ways down. It says a low PE ratio, meaning a low market price compared to earnings, indicates that the market is not confident about the future of the stock. However, it could also mean that the stock's undervalued, which would indicate a good time to buy its shares. So if you think the company is going to be doing something great in the future, it's a good time to buy it. But if it's because they've just consistently demonstrated poor earnings, then it may be an indication that it's not a good stock. It says, on the other hand, a high PE ratio, a high market price compared to earnings, indicates that the market has confidence in the future earnings of the company. However, it may mean that the stock is overpriced and ready for a correction, meaning the price is going to fall. These considerations, plus the fact that Forrest can't directly control the market price for its stocks, are reasons why Forrest has not determined a target range for earnings per share and cannot simply state whether the trend in earnings per share is favorable or unfavorable. So they'd have to look at other financial measures is what they're saying. So the price earnings ratio for Forrest, if you took the market price divided by EPS, and again market price from Wall Street Journal or somewhere, EPS we previously calculated, you're getting 7.3, 7.4, things like that. So that again means that the price of one share of stock is 7.3 times the amount of earnings per share. And what we can tell from this for Forrest is that the market is not willing to pay as much in X3 as it was in X2 for a share of the stock, meaning investor confidence is shaken. They're not feeling good about the company. It's not going in a good direction for them. So we need to do something to restore their confidence, to prop up earnings per share, which hopefully then will drive market price back up and can help our PE ratio. So that's action that we could take. The final one we are going to look at related to market ratios is dividend yield. And it's just what it sounds like. It's the relationship between dividends per share and the market price per share. And it can be calculated for both common stock and preferred stock. So keep that in mind. If I have both, I typically calculate it for both. And how is it calculated? Here it is. So this information is coming from the statement of stockholders' equity. We take common dividends divided by common shares outstanding, which again does not have treasury stock, does not have assumed conversion of anything. So just outstanding shares to get common dividend per share. I do that for every year. I can also do that, get an actual yield percentage, which is better for most people. So I would take that 23 cents I did in X3 divided by the market price per share, which again is coming from the Wall Street Journal or Yahoo Finance, somewhere like that, and I would get 2.4%. And what that 2.4% is saying is that shareholders are earning 2.4% on their investment value, and that investment value is really this $9.50, because that's what the market's trading the stock at right now, so that's the value of the investment. So our standard or target that we want to look at is if we got a 2.4% common dividend yield, what could the investor get on another investment alternative? So looking at other stocks, putting their money in the bank, in a savings account, things like that. So 2.4% is certainly not a very high percent return. But the thing that you got to remember with this is that they're still holding the shares of stock. So that's still a component of return or yield, because if I'm holding the stock and it's $9.50 and a depreciation to $20 next year, I'm going to have a return related to the stock appreciation as well. So keep that in mind when we're doing that. So this next slide, which looks a lot alike, is doing that same calculation for preferred stock. So looking at preferred dividends divided by shares outstanding to get a per share preferred dividend, and then take that divided by the market price per share to get 5.6%. So again, this means that a shareholder is earning 5.6% on their investment of $107. So nothing different, it's just for the other class of stock. So that wraps up really all the ratios. We had the four market ratios that we looked at, and then we looked at all the other efficiency, financial strength, and profitability ratios as well in this chapter. Really important stuff to try to analyze financial statements, and you'll get a chance to do that with Home Depot as well.